Welcome to the Move IQ podcast and First Home Focus series, where we're sharing top tips for all you first-time buyers out there. And although perhaps not the most attractive subject, this one is an important thing to understand as it will have an impact on you and your mortgage. And that is, of course, interest rates. Now, you may not have paid too much attention to them until now, but it's important to get your head around them so you can make informed decisions throughout your mortgage journey. So to help me with this topic, I'm joined by Emma from Skipton Building Society to help explain in an understandable way what you need to know. Emma, let's kick off with the basics. Yep. Interest rates, what are they? How do they work?
So if you put it in very simple terms, interest rates is the amount of interest you will pay on your mortgage. So the higher the interest rate, the higher the monthly payment will be. The lower the interest rate, the lower the monthly payment will be.
There's been so much talk in the press recently about the movement of interest rates, and there's a lot of angst about it, understandably so.
Yeah, so what we've seen over the last few years is base rate, Bank of England base rate has shot up very steeply, very quickly, and mortgage rates have then followed. So people who have come off low interest rates are now facing into higher interest rates and a higher monthly payment.
And how are the interest rates actually calculated, and what affects those rates?
There's a lot of moving parts when it comes to interest rates, and it's not a one-size-fits-all approach to calculating them. I'd say first up being the economy. So when you see high levels of inflation and strong economic growth, interest rates generally follow and are higher. On the flip side, if you are potentially facing into a recession or more muted growth, then interest rates are generally lower.
And does it depend on the appetite of the lender, whether they're keen or less keen to take on risk and
so each lender will have their own kind of plans, their own appetite and their own focuses, and that may change year on year. So there'll be some lenders that are want to be more competitive in certain areas and less so in other areas, and that also then influences what kind of interest rates they'll put out there for customers.
And if you're trying to choose between a fixed rate and a variable rate, and I guess it also depends on the size of your deposit, that all affects the kind of offer that you'll get on interest rates.
Yeah, definitely. So it's one for people that are buying a house to think about. So the amount of deposit that you put down will influence it. Whether there's a fee on your mortgage or not will influence it. Whether you take a shorter or a longer product. As
in whether it's 15 years or 25 years? Or 2 years,
it's more of a 2 years or a 5 year
okay.
fix. Traditionally, we see a lot of 2 and 5 year products in the market. Sometimes there's 3, and historically, these have sometimes gone 10, 15 year fixed rate terms as well.
Wow.
Less attractive nowadays with the rates being so high and people not wanting to fix in.
And when thinking about the different types of mortgages, could you just explain the differences between an interest-only mortgage and a repayment one?
Yeah, of course. So I'm probably best illustrating this through an example. So say somebody is buying a property worth £300,000 and they put a 10% deposit down, so their mortgage is £270,000. A repayment mortgage will mean at the end of the overall mortgage term, so they could take that over, say, a 30-year term, you will pay down that £270,000 plus any interest that you've accrued on that mortgage as well. So at the end of that 30-year term...
There's no debt.
There's no debt. What a feeling.
And what about interest only?
So with interest only, all the customer is doing is paying down the interest and not actually paying down the £270,000 mortgage. So at the end of their mortgage term, they're left with that debt to then pay. And what lenders often insist of is seeing some way of repaying that at the end of the term, because the last thing that anybody needs is a debt that can't be repaid. And typically we don't see a lot of this in the first time buyer space because people are busy saving for a deposit. But it's another option out there for people that have got background investments that could be used to pay it down, and they want to kind of manage their finances that way.
Okay. What's a loan to value, and how does that affect a mortgage rate that the first-time buyer might be offered?
Yeah, so in the example that I used before, the £300,000 house, £270,000 mortgage, that is a 90% loan to value because 90% of that purchase is made up through the mortgage. So typically a higher loan to value is more expensive because the customer is putting down less of a personal deposit. So the bank or the lender is being asked to take on a greater risk than somebody that is putting more of their own money down.
Understood. Could you just talk a little bit about the advantages and the disadvantages of fixed rate versus variable rates? And I understand that's quite a complex question, but can you try and pack it down for us?
Yeah, of course. So a fixed rate is kind of what it does on the tin. So for a set period of time, the rate that you pay on your mortgage is fixed. So your monthly payments will remain static every month.
And people can choose a 2-year fix, a 5-year fix, or...
Yeah, so typically you'll see a lot of 2-year and a 5-year fixes in the market. There are some 3 years, and historically there have been longer fixes when the rates were a bit lower as well.
So the advantages of that is you know exactly what you're going to be...
Of course.
Needing to come up with every month.
Yeah, exactly. But one of the things that could happen is that interest rates fall. And if interest rates fall and you've taken out a fixed rate, you won't benefit from that interest rate going down. You'll only benefit in the future when your mortgage comes up for renewal, and you're then looking at your options.
Okay. How about variable rates?
So with a variable rate, it's the opposite of a fix. So they are subject to change, hence the name variable. And the good thing about a variable rate is if mortgage interest rates go down, your variable rate tends to follow, and therefore you'll benefit from a lower monthly payment. But what is really important to remember is, yes, mortgage rates could go down, but they could also go up. So you need to be really comfortable that in the event of mortgage rates going up, that you'd be able to afford the increase in monthly payments as well. Lenders do a lot of stress testing in the background to make sure they're comfortable that you can afford an increase in monthly payment. But what a lender will feel comfortable with and what you feel comfortable with might be two different things. So it's really important to weigh that up and work out what's best for you.
And how to track up mortgages work, and when might they be a good option for someone to consider?
So a tracker is one of the major variable rate mortgages that are out on the market, and they track something. And quite typically, this is the Bank of England base rate. So for example, you may be paying 1% above the Bank of England base rate. And every time the Bank of England base rate changes, your mortgage payment will change in line with that. So again, it comes down to your appetite for a variable rate mortgage and whether you would want to benefit from mortgage rates potentially going down, but also balancing with that with, could I afford an increase in mortgage payment as well?
So a tracker mortgage will track Bank of England base rate, whatever that does. A variable rate won't necessarily track it.
Yes.
That's up to the lender to
decide how they want to.
And are there any steps that you'd suggest a first-time buyer would take in order to secure themselves the best rate?
Yeah, so I would say doing some research on the market and what's out there and what is suitable for you. So a mortgage advisor can help that, or a broker, and getting some advice on what the best options are out there for you. Another one is considering the amount of deposit you're putting down, because generally speaking, the bigger the deposit, the lower the rate. So if you are in a position where you could put some more down, it may help you secure a better mortgage rate.
What about credit score?
So again, credit score will come into play when it comes to mortgage interest rates, and some lenders will have slightly different options for better credit scores and for less favourable credit scores.
So the lenders will lend if your credit score's not quite where it should be, but the interest rate that they will lend to you will be different.
Yeah, there's definitely some options out there where you may not have the most perfect credit score, but actually you are somebody that the lender wants to lend to, but they may offer you a slightly higher interest rate for that.
Yeah.
But you get people that, have got a history of bad credit, things like defaults, things like CCJs, and it may be that you have to go to a slightly less mainstream lender to get the mortgage that you need. So there's definitely options out there for people that have had a less than perfect credit history.
Okay. But it may cost them a little bit more and require a bit more research, but it's perfectly possible.
Yeah, of course it is.
Yeah. And competition amongst lenders is something I've been intrigued in. Lenders are all in business to lend.
Yes.
They want to lend. And competition is good for that.
It's really good. And I think in my role, what we see is rates changing daily. And there's a lot of healthy competition amongst lenders. But each lender will have their own appetite for what kind of lending they want to do and how much they want to do. And then the rates will kind of follow in line with that. Okay. So a good example is you might get one lender that is really keen on lending to first-time buyers. Typically, first-time buyers have a much lower deposit. So they may be looking at your 85, 90, 95% loan to values, your higher loan to values. And then you may see certain lenders being competitive in that space, but less so at the lower loan to values.
And that can shift all the time as lenders assess their own loan book.
There's so many moving parts with that as well, and rates will change daily. So what you see on one day may not necessarily be available the next.
So actually having somebody to represent your interest, give you advice, a broker on the ground who's understanding all the variables and the movements is going to be really good news.
Definitely.
Emma, great to talk to you. Thank you.
Thank you.
Thanks for joining us on this episode of Move IQ's First Home Focus podcast. We hope you found our tips and advice helpful. Remember, home ownership may be closer than you think, and we are here to support you every step of the way. So please don't forget to subscribe, rate and review our podcast so you never miss an episode. Until next time.